This afternoon, you're listening to the Todd LaBorwit Show, Real Estate Radio and Salem Broadcast Network, WRC 1260 AM. I'm your host, Todd LaBorwit. This segment is brought to you by Research Financial Strategies with Jim Musgrave, our preferred partner for financial advising. And in the studio with us is Jim Musgrave.
Great to be here.
Well, it's good having you in the studio all day.
Yes.
So it's interesting because last time we were talking about a topic, and it was life insurance.
Yep.
And everyone kind of froze a little bit, and we all had our own little personal experience with life insurance. And after the show, we were talking about all our different views. And it's amazing how different views everyone has on life insurance.
It's just interesting how people buy it for different reasons.
Right.
You know, like I may buy it for one reason, but, you know, Jody, the attorney, estate attorney, she goes, I bought it because she would be an emotional wreck. And it takes to deal with the loss of a loved one. You know, I mean, that's a tough pill to take.
And we bought it because it replaces income.
Right.
With the interest.
Right. And so, you know, people buy life insurance for many different reasons. One that is, you just mentioned, replacing income. Another one is also to replace or pay off debt, mortgage, car loans, student loans. If you have small children who you think they might be going to college, you know, college is expensive. And so people will replace income. They could replace.
Well, that's where I challenge you a little bit, because like I understand life insurance is for, like, from my point of view, if something happens to me, we get a life insurance policy that comes in paid in full, and then on a conservative investment, that interest should be a income replacement for me being gone, with a little bit of a cushion of like not being able to work for 3-4 months for their surviving spouse. But you talk about college. It seems like you're buying a lottery ticket to say, oh, I can send my kids to college if I buy this life insurance policy and something happens to me. It's kind of like,
so the question,
I challenge you on that.
Okay, so I'm not going to put you on the spot. Okay, so let's say you take spouse A and B who've got small kids. Okay, well, how much money do you have literally in investments that are allocated towards college?
But if I'm putting money away with my income and my spouse's income, we're in a strategy of saving for that college. Shouldn't the life insurance policy that pays out continue to pay for that policy? It shouldn't be hitting the lottery.
We're not talking about hitting the lottery. Again, you have to, when I sit down with somebody, you have to look at your situation. I say, Todd, what's important to you? Okay, what are your liabilities?
Okay, let's walk through.
Okay, sure.
I have a newborn.
Okay.
We're going to have more kids.
Okay.
We're saving for college. We're paying our bills. Yeah, we got a mortgage.
Okay. So if you were to pass away today, how would that affect the income for your wife and your young daughter?
That money would go into an account, a conservative interest account, and the interest check would come to our house.
But my point is this, is that our greatest asset is the ability to make money. Okay. So you make X amount of dollars per year, and you're a young guy, and so you have how many years to go before retirement? So it could be 25, 30 years, okay? So that's millions of dollars of future income that would not be coming into your surviving spouse, okay? So that's the income portion. Now, but when it boils down to it, it's also how much can you afford? You know, I mean, that's when it comes down to it, yeah, if I could afford a $5 million policy, yeah, I'd buy it. But the reality is that you have to pay premiums.
It's expensive.
It can be. And so that's the reality. So what you have to do is you have to sit down and say, okay, if spouse A passes away or spouse B passes away, this is how things are going to be affected, okay, financially. And, you know, again, I look, you know, how much do you owe on your mortgage? What other liabilities? So you typically, if your spouse can remain in the house without paying a mortgage, that's a huge burden off their back, okay? And then you look at the amount of income that would be the future income that's lost from you now being gone. You can add it up. So you start adding that up, and it adds up really, really quickly. And then you start running illustrations. And
so you're saying get a policy to pay everything off plus supplement the income?
If ideally, however, it all boils down to what you can afford and your priorities and your situation. So there's not anyway, it's per situation. That is what I'm trying to say.
Okay, so every situation is different.
Right.
Just because my perception of how life insurance should be done, someone else could have a situation that's completely different, and they might be at a stage in their life where let's pay off the mortgage, let's do supplement income, and yada, yada, yada.
So you could be a young family with a couple young children. You could be a family with kids in college. You could be a couple who are approaching retirement or in retirement. You have 3 completely different situations, and there's still a need, or could be a need for life insurance.
Now, what about these empty nesters?
Okay, so in terms of the empty nesters, remember when you're looking at retirement planning as a whole, the question is, when can I retire? The answer is that when you have enough income from multiple sources to maintain your standard of living, that's when you can retire. So if a spouse passes away, that life insurance would certainly help, not going into those investments, fast, but also life insurance can be used in terms of if you have a pension. So that also influences the pension option you take. Do you take a survivor option, or do you take the basic annuity and have a life insurance policy? So there's all different. Life insurance is just a tool, and so it's our job as an advisor to understand what the situation is and give our clients different choices and pros and cons of different things, and try to help them figure out the best way to go.
Now, what about, we already talked about me with like a young family with children, or an old guy with young children. I'm in my 40s. And established families, people that have children in college, they're saving for retirement, car payments, then they probably have parents they have to take care of. Like, what about those people that don't have insurance as of today?
Again, the thing is, if you got children in college and you were to pass away, how does that affect their education? So, I mean, again, you just, where's your money going? So those are things that you have to look at. And so another thing, too, is that we haven't talked about are for business owners. Okay, so why would a business owner buy any insurance whatsoever?
I got that.
What do you got?
A business owner has a line of credit. If something happens to them, the line of credit might not get paid back, so the bank will require them to get life insurance to cover that. God forbid something happens. Also, life insurance, if there's business partners in the company and one passes away, the surviving business partner doesn't necessarily want to go in business with the family heir, so they have a buyout to buy out that family person.
That's called a what? A
buy-sell agreement.
All right, keep on going, Todd. You're on a roll. All right, so
I'm out.
You shot all your bullets. Okay, so business owners can use it to fund a buy-sell agreement, to what you're talking about, for the bank for a line of credit. Another thing too is that so let's say you have a business that's doing really, really well financially, and they provide a retirement plan, a 401k for their employees, and they're maxing it out and they're maximizing all that kind of stuff. A company can offer what we call a non-qualified deferred compensation plan. Okay, that may sound like Greek to you, but basically it's a way that the company can actually fund a permanent life insurance policy. The asset stays as asset on the books of the corporation, but so anyway, it's a way that a company can actually fund a policy. And remember that the cash value in a life insurance policy grows on a tax-deferred basis.
Right, you're talking about whole life.
Yeah, whole life or universal or variable universal, but it's typically a whole life policy, yeah.
And anyone that's doing whole life or universal has to have a Series 7 license? Or?
No.
Okay.
Where the security license comes into play if it's a variable product, variable universal life, so you have to have at least a Series 6 to do that because that has investments in it. But you don't need a securities license to sell term insurance, whole life, or universal. So anyway, so that's another thing to do. The other thing is again, I talked about business succession planning. This is another thing that businesses will use it for. So another thing that you may find, Todd, is like group life insurance. So you can that's something that's offered to many employees, or especially if you're a federal employee having group life. So there's pros and cons.
But the benefits go to the family.
Yeah, so you can choose, again, depending on your company and what's offered to you, just to be like 1-time salary, 2 times, up to, if you're a federal employee, you can get up to 5 times your salary. There's pros and cons of that. It's typically pretty inexpensive if you're young. However, the older you get, it gets more expensive. And when you actually retire and take your pension, if you want to keep that same benefit, it's really expensive.
Oh, wow.
And then it will actually,
So people start, as they get older, they have to start making decisions like, am I going to keep it? Am I not going to keep it?
Absolutely.
And if they're not meeting with you and prepared about all this, they don't know what they're in for.
Yeah. And that, again, the federal employees and state employees, it's a little different, but that's something that you really need to get up to speed on, is that how does a life insurance work upon retirement? And so that's something that you need to consider when you're doing that retirement planning.
Well, Jim, we got a lot of good information here, and we're going to have to come back after these messages to continue this conversation, because I got some more topics for you.
We're just getting going.
I know. I love the ones where they talk about for like $1.99 a month, you can get life insurance. We'll talk about that coming up. This afternoon, you're listening to the Todd LaBorwit Show, Real Estate Radio and Sound Broadcast Network, WRC 1260 AM. And I'm your host, Todd LaBorwit. This segment is brought to you by Research Financial Strategies with Jim Musgrave, our preferred partner for financial advising. And he continues to stay in the studio with us because we can't get rid of him just yet. We got to get inside that brain and get it out to our listeners.
All right, what do you want to know, Todd? What do you want to know?
Well, I want to know, I had someone come to me a while ago, and they said, I have this insurance policy I can get. It's very inexpensive. I don't deal with any of this. They just thought I was in the financial sector and I might know something. And I showed it to someone and they said, oh, you have to get hit by a bus and be wearing like a green coat and have mittens on instead of... There were so many rules and restrictions. It was like it was next to impossible to... It seemed like a scam.
Well, you're probably talking about an accidental death and dismemberment policy, which all it is that it'll pay out a death benefit if you die of certain very narrow things, like an accident or this. So it's just a very narrow definition of life insurance.
Okay, so it's not a scam. It's just a...
No, it's not a scam, but you look at, why do you buy life insurance? You buy it because there's a reasonable chance that you and I are going to die at some point. And so... I don't want to have the definition of when the policy is going to pay out based on how I pass away.
You want it to be a benefit for you if something happens, not like a lottery.
Right. So so in a nutshell, I typically don't deal with those AD&E
I don't know anyone that deals with them.
Yeah. So
it's almost like an insult.
They sometimes will tack it on to something, but I've never once sold an AD&E policy. It just never comes up.
All right, well, let's move forward. What's the difference between term and permanent life insurance?
It's a great question. Okay, so think about renting a house, since we're on real estate radio. Think about renting a house or an apartment versus buying a house or an apartment. So with term insurance, you're buying a death benefit for a defined period of time. Okay, you got a roof over your head, but you have no equity in that term policy. Okay, so if you buy a 20-year or a 30-year term, once it's up, it's up. Okay, so term insurance is designed to basically, actuarially speaking, never pay out. Roughly 2% of all term policies actually pay out. Okay, because statistically speaking, you're going to live far beyond, the 20 or 30 years that you buy the term policy. So term insurance can be a really good thing. If you're young, it's cheap, and you have a temporary need. Let's say we talked about the kids going to college. Okay, I want to make sure I got $500,000 so I can pay off most of my mortgage and make sure that my kids get through college. But after that, that need kind of could potentially go away. So that might be a need for term insurance. Okay, there's some advantages to that. It's the least expensive in your younger years. Again, you only pay for a limited time. One thing you can do is that many of these policies, or most of the policies, are convertible. And I'm not sure if you know what the convertibility option is with a term policy, but what it allows you to do is that, let's say, Todd, you get a policy and you're young and healthy and you're a non-smoker, and so you have a very good underwriting class. Time goes by and you come down with a terminal disease. I'm just giving you an extreme example. And so obviously, if you went out to get a new policy, it would be you would either be uninsurable or the premiums would be really high. So the convertibility allows you to convert your term policy to a permanent life insurance policy based on the underwriting that your policy was issued. So that's a really neat feature. And also, you're probably aware of different riders that you can add to these policies. The accelerated benefit riders. Their traditional accelerated benefit says, so Todd, If your doctor says you have 12 months or less to live, then you can tap into a percentage of your policy and use that money while you're alive before waiting for you to pass away to have that money go to your spouse. And so they've kind of broadened those definitions of these accelerated benefits to chronic and critical illness. And so they're trying to cover some of that long-term care need to an extent.
So what happens if you have a terminal illness, you cash out, and then you end up surviving? Do you have to give it back?
Chances are you're not going to survive. I mean, literally, the doctor says, Todd, you have 12 months less to live. And so how that works is, let's say you had a $100,000 policy and you took out $50,000 and then you passed away. Your beneficiaries would take that $100,000 minus the 50, and they would get the net amount of that.
Well, what are the disadvantages?
The disadvantage is that term insurance is very expensive when you get older, and once you turn age 50, it's very hard. You can buy a 30-year term policy when you hit 50, but once you hit age 51, it's hard to find. So it's hard to find a term policy that goes out, past age 80 roughly. There's no cash value. Okay, so if you miss your premium and you can't afford it, you go into a 30-day lapse period. And then boom, it's done. And so you don't have that cushion like you would in a permanent coverage, which kind of gets me to the difference between a permanent life insurance policy. Okay, so we just talked about term. We also have permanent, which is your traditional whole life, your universal and variable universal, and there's also an equity indexed UL. So I just threw out a bunch of terms that you may not know what they are, but
I was having fun on term insurance, and now this permanent life insurance is starting to.
What the permanent coverage does is that it takes the variable of when you're going to die out of the equation. Okay, so if I knew that when Jim Musgrave, was going to die, I would tell you what kind of policy I should own, right? If it's within 30 years, I'll buy a 30-year term policy. But I don't know when I'm going to die. And so I want to take that variable out of the equation. So most policies will be guaranteed age 100. They can go up to 120, okay? So that gets you beyond that bell curve. So essentially what a permanent policy does is that it actually, you're pre-funding the expensive insurance down the road. You're kind of front-ending it. So you have the cost of insurance and you have your premiums, which are a little higher than that, and that actually builds in this cash value.
Okay, I think we're getting into the realm of this is when they have to sit down with you and go over the different options. It's almost like when you're going to buy a house. Should I do a 30-year fix, a 10-1 arm, a 7-1 arm, a 5-1 arm?
Right.
What should I do? And it gets very complicated when I first sit down with people.
Sure, absolutely.
And I don't think we're going to be able to get it through on the radio.
Probably not.
Because you got whole life, universal life, variable life insurance, or variable universal life insurance, and equity index universal life. It's beyond confusing.
Yep.
But the two most popular ones that I know that are out there, and correct me if I'm wrong, is the term insurance, term life insurance, and the other most popular is whole life.
Yep.
Let's talk a little bit about whole life.
The main advantage of the whole life policy is that most whole life policies will actually generate a dividend, and that dividend can be used either by additional life insurance or it could be used to pay down that premium. So the premiums of whole life policies tend to be a little higher than universal life, but with that extra premium, that cash value really, really builds. And you get to a point where that cash value gets to a high level and the actual death benefit starts to increase as well. So you can use what we call those PUAs or paid up additions to actually pay for the premium. So you could conceivably have enough cash value in the policy that's generating enough dividends to actually pay for the premiums. So, which is a pretty cool thing.
So let's say I come into an inheritance.
Okay.
I can just do a lump sum and pay into like a whole life policy, or do I just have to? What are some strategies that people are using whole life policies for?
Whole life policies are generally used again for the permanent coverage. They're used again when you have cash value in your life insurance policy. You can take loans and withdrawals out on that. And you can use it to pay for college, retirement, or just take money out to spend for whatever. Okay, so those are some big advantages of that. And again, as I mentioned in the last segment, companies can use those to fund non-qualified deferred comp plans, and those sorts of things as well. But anyway, so the cash value can be a very, very powerful tool.
Perfect. Well, by the way, if you're just tuning in, I have with me Jim Musgrave from Research Financial Strategies. I'm your host, Todd LaBorwit, and you're listening to Salem Broadcast Network, WRC 1260 AM. Now, Jim, moving forward, there's I have my health and life license, but I don't really practice with it. And what we used to do is when the interest rates would go up and nobody was buying and the housing market would plummet, what we would do is anyone that had a house, we would get mortgage life insurance, where if one of the spouses passed away, the mortgage would be paid off. It was very affordable, and it was targeted towards people that just bought a house. Yep. Because it was like finding a needle in a haystack. But once they bought the house, we could find that information. And then the other was someone that just refinanced, whether they had to do a cash out for whatever reasons they had to refinance. We would do the mortgage life insurance. Now, it wasn't through a Topaz. It was an individual thing I would do. Let's talk a little bit more about those policies.
Essentially what that is that it's a way that the insurance agents can ultimately sell more term insurance. All a mortgage protection policy is a term policy. It's as simple as that.
But what they used to do is, as the mortgage got paid down, the policy would go down, and they got rid of that. Now they just do strictly term, and it's a marketing ploy.
Yeah, there on some of the death benefit options. Let's say I'll make it up. Let's say you have a $100,000 policy or life insurance. There is, after a certain number of years, there's a decreasing death benefit, and that's one of the death benefit options that was used or can be used in a mortgage protection. Because you're right, as you pay that principal down, if you got a $100,000 policy, but your mortgage is at 100, it's at 90, 80, or 70, then if you pass away, it's just extra death benefit. If the purpose is truly just to pay off the mortgage. Typically, as we talked about, there's other needs for life insurance other than just paying off the mortgage. So, if you had a $100,000 policy and your mortgage is now 50 and you die, that $50,000 is certainly going to go to good use.
Of course.
Yeah, absolutely. But the mortgage protection stuff it's primarily a marketing idea versus it's not a different product.
I guess it's taking a life change.
Yeah.
And not exploiting, because it is a good coverage, but when you move into a house and you just refinanced, what's hotter than saying, I just saved $300 a month on my mortgage for $50 extra a month that I didn't know I was saving anyway. I can go ahead and, if one of my spouses passes away, the mortgage is paid off.
Right, because what happens is that you refinance your house, you move or whatever, and 60 to 90 days down the road, you get a letter that arrives at your house. Hey, you just refinanced, or you just got a mortgage of $250,000, and contact us to learn about mortgage protection insurance. So they're identifying a need, and it's a legitimate need.
Right.
Yeah.
I used to sell those. I haven't done it in years.
Yeah. But one of the things that's also popular is that we talked about underwriting a little bit. So if you are super healthy, non-tobacco,
that's a good conversation to have. We're talking about underwriting. I love where I'll meet up with friends and they'll be like, oh, you got to use this guy. He's great. He got us under the radar. And, I haven't had a cigarette in like 30 days. And he did, people seem to lie on these applications.
You can't get away with it.
You can't get away with it. I'm like sitting there, I'm like, if something happens to you, they're going to challenge this and see.
You won't even get that far, because what happens is, Todd, and you know that because you can write this stuff. So you fill out the application, and they ask all these different health questions. And so let's say you lie on the application that you are a non-smoker, and you are. Okay. When you have a medically underwritten policy, you have to get a physical. So the nurse comes out there and takes some blood and urine sample, and I promise you they will find nicotine and whatever drugs you're taking in your blood and urine sample. Okay, they're also going to request your medical records from your doctor. Okay, so you can't hide from the underwriters. And I always say, be honest.
But it just blows my mind that people are going to specific people to get insurance because they feel like they can get them under the radar and get them a better policy. And I don't know who exactly the person is. I just remember the casual conversation. I'm like, people are popping up. Everyone's mother, brother, and cousin can pop up to sell life insurance, but there's actually credible people.
Right.
And when it comes to mortgage life insurance, yes, that's the only product that I know. But as far as the other policies, I would be scared to personally do a policy for $500,000 on somebody because I really don't know what's going on.
Yeah.
I have to refer to a financial advisor that knows what the purposes are for and what they are.
There's a difference between a product salesman and a financial advisor.
It definitely is.